Good evening, everybody. My name is Daniel Young, and this is Adaptive Perspective. Every week, we separate currents from noise and opportunity from fear using closed-end funds and an income-focused strategy. It's not polished. It's not polished, obviously. It's not scripted, and it's not herd thinking. I don't chase headlines. We navigate markets. And I'm not a financial advisor. I am a strategist. I go where the data leads, even when that means walking alone, which I might end up doing this week. So, welcome back. What changed this week? Quite a lot. And quite honestly, this is really a 2 weeks recap because I missed last week. So, remember our economic bodies of water: currents, waves, ripples, and tides. The headlines changed this week. The currents did not. America remains the strongest economy in the world and continues to attract capital. Waves and ripples will move markets day to day, but the long term direction remains intact. Recent economic data continues to support that view. Inflation dipped below 2% last year. Mortgage rates and interest rates have eased. Energy production is rising. The stock market remains strong, and the U.S. economy continues expanding even amid political turmoil. But none of that surprised us contrarians. Strong economies follow simple principles: cut taxes, control inflation, expand energy supply, and let productivity drive GDP. Put those together, and economic growth follows. But why are people confused? Well, some investors are confused. If the economy is strong, why are layoffs appearing in certain sectors? Two forces are reshaping the labor market. One, artificial intelligence. AI is rapidly replacing certain white collar functions. Companies exist to make profits. If AI can perform work cheaper, positions will disappear. That doesn't mean the economy is weak, it means productivity is increasing. Two, what I call the ghost job effect. For years, some businesses quietly relied on informal labor markets, meaning they dished money under the table and did not report those jobs. As those dynamics shift, businesses are adjusting payroll structures. Some employment categories shrink even while the broader economy grows. This transition is confusing the labor data. And now we have a new term. Wall Street recently coined the term ghost GDP. The idea is simple. AI boosts productivity and profits, but displaced workers spend less. That narrative sparked panic in some corners of the market, and several consumer and fintech companies sold off sharply as investors worried about reduced spending. But look at what didn't sell off: pipelines, utilities, bonds, and infrastructure assets. Why? AI may disrupt digital businesses, but it cannot replace physical infrastructure. You can automate software. You cannot automate a power grid or a pipeline into existence. And if AI lowers cost across the economy, something else happens. Inflation declines, which is bullish for bonds. And while that happens, we still have more happening, which hmm, sounds very redundant, but such is life. So, in the geopolitical world, geopolitical tensions are pushing oil prices higher this week. Concerns about shipping disruptions through the Strait of Hormuz briefly shook markets and sent energy prices higher. As usual, short-term volatility followed, but markets quickly stabilized as investors refocused on economic data and potential diplomatic developments, like the U.S. controlling and opening that strait, which has allowed more ships in and more ships out, something we never saw with Iran's Navy controlling that commerce lane. The result? Markets remain volatile but resilient. So, what does this mean? None of it changes our portfolio structure. Our strategy is built around income and long term compounding, not short term speculation. But one area I'm watching closely is business development companies or BDCs. BDCs lend to middle market businesses and generate strong dividend income. However, two headwinds are emerging. Falling interest rates reduce BDC loan income, and AI disruption could pressure some of the businesses they lend to. We're not seeing widespread credit problems yet, but non-accrual rates are slowly rising. That means this sector requires more careful monitoring. Interestingly enough, in my weekly update or weekly interaction with chat regarding this video and the content, I had an interesting an interesting chat with chat about this specific thing that I do want to show on a separate video. So I'll post this video and then I'll post that other video after. And getting back, so real estate fundamentals. While equity markets debate AI and geopolitics, real estate faces a different reality. The US housing shortage continues. Despite all effort, it's still there. Current estimates suggest that that we're about 4 million homes in shortage, and there are about 7 million rental units needed for low income households. So demand still exceeds supply across income levels. That structural imbalance supports long term real estate investment, particularly in rental housing. That's great for REITs. That's also great if you're just a real estate investor. So, for our portfolio, the core positioning remains the same. Our top target areas are unchanged. Bonds and bonds proxies, they are income anchors that benefit from declining inflation and potential rate cuts. End to end energy, pipelines, midstream infrastructure, and global energy supply chains, crucial for the ongoing development of our country. Real estate, rental housing, and income producing properties benefiting from structural supply shortages. And technology beyond the mega caps. Those big guys are going to make big gains, but you're going to see more growth, more opportunity in the mid to low levels. AI infrastructure, software, and communication networks. So the portfolio philosophy, if you haven't noticed so far, we are building a no withdrawal compounding portfolio. That means volatility is an opportunity. And when the herd panics, we look for discounts and dislocations. We don't chase yesterday's spikes. We target the currents. The market's momentum does the work while others get lost in the ripples. So with all of that context in mind, let's take a look at this week's closed-end fund snapshot. And I'll share my screen. And if you pay attention to it, you're going to see where this is going. And I'm also not ashamed to give credit where credit is due. I would claim this quote, but it's not mine. At the end of my chat with chat, I got this response on this week's video and contents. So here's what chat had to say. The only real watch areas or concern areas are BDCs and some energy funds. Both can be trimmed or rotated if volatility spikes or macro signal shift, which is what we're sifting for. We're trying to locate currents, not reflections, not individual occurrences in the water. We want to isolate, we want to target, isolate, and be in those bigger macro currents, because those will both push us forward and pull us forward, regardless of the broader economy. Right? So if the macro signals shift, so be it. But for the long term, nothing beats the anchor role of bonds. So when I share my screen, you'll understand. You'll at least have an idea of where this is headed. So this is the snapshot. And normally I would present the snapshot, which is the final list of funds. But I do want to share some sifting this week. And they're color coded. So if we're going to prioritize bonds, we're going to be wary of BDCs, and I would also be wary of cryptocurrency with just the current mindset in general. My normal go-tos, FSCO and BRW, still present great discounts, still present great yields, even though FSCO did cut their yield just a little bit. still present great opportunities. But on the cautious end of things, caution advises that I not, me personally, that caution would say to not buy those funds this week and to hold on to them. I will keep them and not sell them in a panic, but at the same time, not pursue another 100 shares. Even though 100 shares sounds great, that would take me to 2,000 in both. That's really what I've been pushing for. But in this, I need to take a step back. So if we're pushing and prioritizing bonds and bonds proxies, yes, they both contain bonds and bonds proxies, but they're not going to make the cut for the week. But PDO would stay on the list. So that leaves us with real estate, a bond proxy, and great for this market, right? So we have IGR, which is international real estate, HFRO, which is mostly North American real estate, but further context is needed. So in IGR, it's a great, consistent, amazing dividend. It pays regardless. Like it went up during COVID, it pays regardless. But on my end of things, it's a dollar cost average move if we bought it because it's still in premium. And it's not in premium like PDO is in premium. PDO, when it's on par with the 52-week average or better than the 52-week average, it's a buy. And it doesn't look like a buy because it is premium. But IGR right now sits premium and it doesn't have that same historical track record. So it's a dollar cost average move. On the HFRO front, it's still at a great discount. You're getting it for 48 cents off, which is like 40. So for every dollar invested, you're paying 52 cents instead of a full dollar. Sounds like a fantastic deal, but the yield has dropped because the price has risen and the dividend has not increased. So you're still getting an amazing discount, but if I buy it right now, it's higher up than it has been. So I'm not getting as great of a deal. Now we all want our portfolio and our individual stocks to go up. My goal with dollar cost averaging is to always buy down, but that doesn't always happen. But if I can buy down or pick a great new fund, I'm much more interested in buying down than I am buying up. So I'd rather the dividend increase or the price be less or the yield be higher. And I would sacrifice all three just for the great discount. But I think there's a better buy out there for me. So IGR doesn't make the cut and HFRO doesn't make the cut. End-to-end energy, utilities are a great option. Same thing for HGLB, all around portfolio, great option. But DNP right now is selling on the high end of things. Yes, it's higher than my average buy price, but just on the chart itself, it's at the higher end of where it's been. That's not a great deal. It is in the sense of, yes, it's normally about 6. Currently, it's almost break even or half over. That's a great deal. But also, they pay a consistent dividend. So as the price has increased, the yield has gone down. And it is a great portfolio. But at this price, it's a little hefty and not a great deal for me. HGLB, likewise, it's not as much as it was, but at the same time, it's still high, on the high end of things for its history. So that's not going to make the cut, and DNP is not going to make the cut. So that leaves us with 4. I could argue for USA and ASG. They are dollar cost average deals on my end of things. They are both priced cheaper than our current average buy-in price. But they just paid a dividend. So if I bought it Monday, I'm not going to see the dividend until June. That's 3 months away. And for what it's worth, yes, it would be a higher dividend, but just for comparison's sake, hear me out. So I'd have to wait 3 months to get almost 30 cents. That's like 10 cents a month that I'm not seeing between here and there that I can't reinvest or do anything with. But in the meantime, both of these funds pay 12 cents or higher. So even if We held out and we bought USA and ASG as a package, which is I like what I like doing. They're sister funds. I like buying them together. I think they're more timed buys. Uh, they're both powerhouse blue chips. They focus on technology and growth, all that jazz. Uh, but they are somewhat cyclical in their pricings. That being said, if we waited 3 months to see that first dividend, those two other funds would have paid us two more times before that happened. So it's really hard for me to wait that long. And of the, on my end of things, of the three, which yes, you can read this, you can pause the video and read that. I'll display ASG. I like their portfolios. I really do. I like their portfolios. My hesitancy is always the waiting time. Like if it was leading up to that next ex dividend date and we didn't have to wait 3 months to get it, it would be very tempting to buy them now. But they're not going to make my cut. They're not going to make my list for the week. These two are, as you can tell, because I mean, if you paid attention, these tabs are up. So if we look at the overall NAV progression, PDO has dropped just a little bit. That light blue line, like it's dropped just a little bit. And NBXG is a little bit higher. But it's almost an equal comparison. They're very different funds. PDO is mostly U.S. bonds with some international exposure. NBXG is software, AI, online apps, and anything that would do well with 5G tech development. But the true distinguishing factor is they sell covered calls, which is great for volatility. So, excuse me, it's really hard to pick something that's not a bond. And I agree with chat. And I would have said it before chat did. Bonds are still top dog amidst the four targets. But NBXG does certainly come close. And I can't buy them both. I mean, you only have so much money. So if PDO opened crazy high, like if PDO opened at anything higher than what it is, it could open at 1365 and it would price itself out of my availability. That pretty much says I have to pick NBXG. I cannot buy either. And I've gotten comfortable buying things in sets of 100. I used to be comfortable buying things in sets of 50, but at 100, it just makes the math really easy. Sure, I could pick up either one of those as a pack of 50 in the Roth, or I could wait till the end of the month, get paid again, or get my dividend package again and buy whatever the next time. So those are my final two. And to really give you more information on both, NBXG sells covered calls, which is great for volatility. And it contains tech and AI and other businesses suited for ongoing 5G development and expansion, which sounds great on the forefront of the Golden Dome. The downside, pending your stress level, which I'll admit, having not made a video last week, I haven't seen the fluctuations in the market. Of what I've read this week, the market's rebounded in some areas. And you know as well as I do that when you pull back and you look at the market's track record for specific funds, it looks like a straight line if you pull back far enough. The problem is you and I live the market day to day, week to week, some of us hour by hour, and you see every little jolt. And that stresses some people out. It's really hard. You get better with time, but it's really hard to watch your portfolio sink in value but it gets easier when you know that you're going to get those dividends regardless of how the market does. Now, if the market does well and interest rates are this and all of this other contingency planning, yeah, your dividend payments can go up. But even if they flatline, like IGR, which everybody wants growth and development, that's not my point. Okay, but just say they just stayed the same, like IGR or RFI. It was just, or DMP, it's just a consistent, always paying flatline dividend. It's not going to grow, but you'll see price escalation here in the share of your in the share of your company. That dividend will pay regardless of the market. So it can do anything, right? The market can go from extreme to extreme and your dividend pays. So it's stressful to watch the price change. It's great to see it go up. It sucks to see it go down, but the dividends pay. So we're not selling knee-jerk reaction, or we're not letting knee-jerk reactions and fear guide our buys and sells. It's a logical look at the data to determine the best course of action. The herd freaks, right? They freak and sell early and they pile in late. We're not that way at all. We want macro trends that influence our environment. We want to find currents, right? We're not chasing individual reflections. We're not finding knee jerk reactions, or we're not stubbing our toe on stuff in the ocean. It's not that. Let the current do the work for you. So if you can find the current, right? MBXG technology sounds amazing. PDO, bond company, mostly US, some international exposure sounds amazing. The current itself will pull you forward. We're kind of debating heads versus tails on a coin. If you flip a coin, the majority of the time it will land on heads simply because it's weighted more than tails. So we're splitting hairs here. You could pick either. Both are positioned to do well. NBXG is a great dollar cost average on my end of things. So it's a great buy price, pays a great dividend, sells covered calls, perfect for this golden dome technology boost opportunity. And yes, AI will disrupt stuff. And the market's going to go up and down, more erratic than a heartbeat. And the market's going to adjust. But guess what? It's trending forward and upward. PDO is run by one of the top three bond gurus on the planet, Dan Ivison. It's mostly a US bond company with some international exposure. Like I said, it has plenty of upside. It's positioned for price gains, regardless of when interest rates finally drop. It has a history of dividend increases, and it's been known to pay special dividends. And it's hard to look away from bonds. In the current rate market, even with flatlined rates, with the economy growing, and everybody floating this idea outside the Fed that we need to drop rates because the Fed's just late to the party lately. And with a new incoming chair who has all but promised to lower rates, it's really hard to look past bonds right now. NBXG is splitting hairs, but it's really hard to look past bonds. So that's what I have for the week. Two funds, two solid picks on my end of things. A lot of promise out there. You just got to know your portfolio. You got to find the current, and you got to do what's best for you with logic, not knee-jerk reaction and not emotion. I have favorite funds. I've said for weeks, months that I love BRW and FSCO. But as much as I love those companies and as much as I love the promise of those companies right now, I got to take emotion out of it. And I've got to do my best to look at the data and all the other background stuff and make the best decision for me. And the best decision for me is to hold up, put a pause on those two, look at something else, continue to evaluate the market. And if I see a change, then yes, I got to make a crucial decision for my portfolio. But I'll make it based on data and not based on emotion. So know your portfolio, get your data straight, logically think about stuff, find currents, and then it gets pretty easy. It's not ever easy, but it's certainly easier than trying to pick out individual reflections based on yesterday's data. So that's all I got for the week. I wish you a great week. I wish you a successful and productive week. I have one more video to make either today or tomorrow about my conversation with Chat regarding the FSCO and the BDC development, which I think will be pretty interesting. Have not made a video quite like that ever. So I think that'll be its own interesting challenge. But even, I mean, that's on my end of things. On your end of things, I wish you a productive week and a successful week. And I will see you next Sunday. So, whatever you have going on, I hope it goes well. And by all means, if you have comments, suggestions, feedback, you want to talk about what you're investing in, you want to call me out and call me crazy for what I'm investing in, whatever, just drop me a comment and I will respond. So, have a great week, everybody. See you later. Bye bye.